You're listening to the greatest multifamily investment advice show. My name is Adam Ras, and now I'm talking everything multifamily for an in-depth conversation, and I will be diving deep into raising capital, deals, and underwriting process. Welcome back to the greatest multifamily advice show. Today we have Brian Burke, an exceptional guest with more than 20 years of experience on multifamily, leader on the real estate market, marketing mogul, one of the main keynote speaker on Bigger Pockets. Please help us to welcome our guest today. How are you, Brian?
I'm doing great, Adam. Thanks for having me here.
Thanks so much for being with us today and taking the time, and I appreciate you taking the time.
Absolutely.
So I would like to start with your background from single family to multifamily and all of the commercial spaces. Can you tell me what was the beginning for you?
Well, the beginning for me was back in the late 1980s when I made my first real estate investment. It was a single family rental property that I purchased. I didn't even own my own home yet. And I was only 20 years old and really didn't even know what I was doing, but figured that, most millionaires were made in real estate, and I wanted my part of that. So I thought I'd give it a shot. And, 3 years later, I'm still doing it. So somewhere along the line, something went right.
So what was the actual upside for you to go from the single family to multifamily and then realize, okay, I have to diversify my portfolio to different commercial spaces? What was the upside for you for this?
Yeah, well, I'd been flipping houses was my main business, and I was doing that for several years. And I was, buying houses, fixing them up and reselling them. And then every once in a while I'd keep one and rent it out. And then after a while, they'd gone up in value a little bit. And I thought, I should try apartment buildings because I've never really gotten into that space. So about 20 years ago, I sold a couple of my single family properties and did a 1031 exchange into a 16 unit apartment complex. And that was my first experience in the multifamily world. I didn't even know really much about it, but I learned really, really quickly because that's what happens when you jump into the fire feet first. So it was a really awesome learning experience. Over the years, I did it a few more times, kind of in a similar way, just buying smaller multifamily. And then finally realized it was about 15 years or so ago that, larger multifamily properties was really the future of our business. And we had built a great business on the house flipping side. We'd done about, 600 or 700 homes by that point. And we had a lot of investors that were looking for opportunities to invest in. And, the single family foreclosures were kind of going away, right? I mean, that was a big thing when the economy collapsed. It wasn't such a big thing about 5 years later. And we knew if we wanted to be able to, keep these investors and have a place for them to put their funds, we'd need to get into something more scalable and something more sustainable, and multifamily really rung both of those bells.
So right now, what is your focus? It's focused more on the Southeast or all over the States?
Yeah, our focus is mostly in the Southeastern US. I mean, we own all the way from Arizona to Florida and kind of everything in between. But we're really primarily focused in those southern states. We don't own anything in California anymore, even though we're based here. We're not really doing anything, kind of north of Nevada either. So far, we're kind of sticking to the southern latitudes, and that's been working out pretty well for us.
I think that the big winner on the last 2 years because of the COVID was the Southeast. And the main thing of this is the market fundamental, especially the net immigration and the less taxes on the South states, the overall lifestyle on the Republican states especially. But my question is, how you see the long-term market fundamental on the Southeast? You think it's going to maintain the same performance, or potentially everything is going to get to the previous status when everyone get back to the North states?
Yeah, I think that it's not going to produce the same performance. I mean, what we've seen in the last 24 months has been rampant rent growth. About 6 months after COVID shut the world down, we'd seen nothing but massive rent growth. especially in the southeastern U.S. and southwestern U.S. as well, in terms of like Arizona, Las Vegas, Albuquerque. A lot of these markets have seen massive rent growth. And this has been primarily due to population movement and demographic shifts, where people are leaving states like California and going to states like Arizona, Texas, Georgia, Florida, leaving New York and going to Florida and Atlanta and, kind of some of those eastern markets, Carolinas. So they've just benefited from massive population movement, and that's created incredibly strong rent growth. In some cases over 20% annualized rent growth, and it's been just massive. But do I think that's going to continue into eternity? No. Inflation has taken a grip on people's surplus income, and now gas is higher, food is higher. I mean, pretty much everything anybody wants to buy is higher, and those other items are now competing for people's disposable dollars. So rent isn't the only one there to grab it. What that ultimately means is people can't afford these rent increases anymore, and there becomes just a tolerance limit. And I think it's not going to be long before we see that, and that's going to slow rent growth dramatically in even really good markets. But it could be even worse in some of the bad markets, and markets where people were moving from. I don't think there's going to be an influx of people moving back there. There was a lot of people that moved from, California to Phoenix, but you're not hearing of them coming back a year or two later. I mean, they're putting down roots and staying there. So I think that those markets that have performed very well over the last couple of years are going to continue to perform well. They're not going to do what they did, but they're going to probably be a better place to invest than markets that haven't done well over the last couple of years.
I want to ask something of this question, which is basically, you mentioned that you're over all of the southern states. Can you tell me the secret sauce for you to start to work on different states with different teams? Especially, I don't think you have boots on the ground on all of that. What was the main secret for you to able to work on different states with different teams?
Well, for us, it was really just about having the infrastructure there to do it. And it's not something that you can, one person by themselves can run a multifamily operation all across the country. And that's certainly, that was my avatar, 6 or 7 years ago. It was me, and, I had one partner, and, we were trying to grow, and we grew down into Texas, and my partner ended up moving to Texas. So we actually had a physical presence there, but to expand outside of the markets where we had a physical presence, I was finding extraordinarily difficult. Just through stroke of luck, I ended up getting connected with my now partners, but at the time they were just friends of friends that were in the industry and were looking for a new opportunity, and they ultimately ended up joining Praxis. And these three guys brought with them 100,000 units of multifamily experience, because they worked for like all of the household name large private equity national shops, and they had a lot of experience running national portfolios. That was the catalyst that allowed me to expand this business to where we could become more of a national player, was because now we had people experienced in running portfolios across the country, had resources on the ground in markets all across the country, had experience in markets all across the country, and we're able to build our team where we actually do have physical presence in our markets. So it's not one where you can just kind of land in there and all of a sudden get going. It really does. It takes time, and it takes skill, and it takes somebody with experience doing it in order to make it happen.
I think this is really important to understand the actual benefit of active partnership, or having another sponsor, because this is a team sport. Like, you need to understand you cannot actually expand even with the experience, even if you have money, even you have the connection, but it is what it is. You have to have an actual team to work with you on this, an acquisition, deposition, investor relationship. It's hard to work with yourself, even if you have all of this aspect and you're good on all of this aspect.
Yeah, I did that for a decade, and it didn't really get me very far. I had flipped a lot of houses, but it was never really a extraordinarily profitable business. I made a living at it. It wasn't until I realized the value of really well-placed strategic partnerships that this business really took off and got legs. I mean, it's the most important thing is having the right team.
Yeah, but when you mentioned the right team, what was basically what you're looking for when you started to grow in a partnership? I don't think you're looking for someone exactly like you. You need something different than your skill set.
Well, when I had some of my early partners, that was exactly what I looked for. I looked for myself. If I could look in the mirror and see me, you're my partner, right? And that didn't really do a lot of good because I didn't need two of myself. I needed somebody that wasn't me that could fill in the gaps that I didn't want to or couldn't fill myself. And so you're absolutely right, Adam. I mean, you have to find partners that complement you and bring a skill set that adds value. Bringing yourself to the table doesn't add any value. It just duplicates what you already have. It doesn't actually cause you to grow.
Yeah. I want to jump to another subject. Is always I hear it with my investor as what is make me different than REITs? And always this is an interesting question. How you handle investors' objection to compare to you the REITs and the fund managers and so on?
Well, I mean, it's a totally different animal. REITs are bound by very specific investment guidelines. They're also generally publicly traded, or at least privately traded, and by virtue of their trading on the broader markets, they have a stronger correlation to the overall equities market. So when the stock market goes down, REITs can take a beating. But at the same time, private real estate could do very, very well. So REITs are fine for people to add to their portfolio. I don't discourage people from investing in REITs if they feel that they want to have that as part of their portfolio. But what private real estate offers is non-correlation, or at least less correlation to the broader markets than they're going to find in the public REIT sector. And if that's what you're looking for, is to have some diversification against public markets, which is what alternative investing really is, then you're only going to find that in private real estate.
Okay. My next question about the actual recession we have as an advantage player on the market now with your team and your partners, how you see the current recession, and if there's any similar indication to the same fundamental of the recession lead to the same 2008 scenario or not, including job market and market growth.
Yeah, every recession looks different, and we're certainly, no one has said that we're in a recession yet. There's a lot of opinions that we are heading towards one, and we may or may not. No one really knows for sure. Unfortunately, we only really know after the fact. But what we do know is we can see and observe real time what's happening in real estate, right? When your residents start saying, I can't afford that $25 rent increase, or you're getting more move outs than move ins. I mean, those are kind of your first indications as a real estate owner, that there could be some, rocky roads ahead. And so we have to pay attention very closely to those kinds of anecdotal things. But every quote unquote recession, as called by the people who call that, whoever the heck they are, they all look different. I remember the 2000 .com bubble, 22 years ago. That didn't affect real estate at all. None, zero whatsoever. I mean, I was buying, flipping, reselling houses, renting houses. I didn't feel anything when the .com bubble happened, but they called it a major recession. Contrast that to 2008. This was a recession that was caused by trouble in the real estate market. And so therefore, real estate took the hardest hit of everything. Houses fell 50, 60%. Rents were dropping, occupancies were falling. It was a total bloodbath in real estate. And so, it really depends on what caused it. Right now, if there is a recession that's coming, it's probably caused by inflation and interest rate fluctuation, not necessarily real estate. So it probably will look different from any of the past, recent past recessions. So I think it's going to have some impact on real estate, but it's not going to look like 2008 again. If you're waiting for prices to fall by 50 or 60%, I think you're going to get disappointed.
Yeah, but the impact right now, I think it's the interest rate and the actual inflation on the selling point of view, from the seller's point of view. So there is an actual back and forth between seller and buyer right now, waiting to the market to settle down a little bit, I think, on the next 3-4 months, until I think November coming. But no one has crystal ball, as I think. So yeah, we're waiting for the cooling the market to cool down a little bit, I think so.
Yeah, there's a little bit of a standoff right now, where, sellers, they might want to sell, but they think now might not be the right time. So some sellers might be holding off. Some sellers might be thinking their property is still worth the price it was worth 6 months ago, because there has been a decline. Now, I don't think that decline is material year over year. I mean, if you were to compare today's prices to, say, March or April or May of 2021, yeah, they might not be down that much. Maybe slightly, maybe not at all. But compared to where they were in January of 2022, there was a massive increase in prices in the fourth quarter of 2021. That went into the first quarter of 2022, where people were paying what I call an emotional premium for real estate. And this was, I've got to get in. There's a fear of missing out. There's a ton of money chasing not many deals. Anytime you put a multifamily property on the market, you're getting 24 offers, all way over the pricing guidance. Those days are over. And, now we're not seeing any of that happen. And prices have fallen precipitously from where they were in January and February of 2022, maybe even arguably March. And, that's obviously caused, some buyers to take a wait and see approach. It's caused some sellers to be maybe in disbelief and think they should still get the same old price. And so there is a little bit of a standoff right now while people wait to try to figure out exactly what's happening.
Yeah, I think this makes sense now, because we had a similar situation when we able to little bit negotiate the price with a seller. It was a deal already in Atlanta, and we managed to convince the sellers that even if you didn't get what we're offering, where you can find this price again. Yeah, so I agree on this on the market right now. My next question is different now, is about your model. Where do you actually like on your business model? Do you prefer the syndication model or the fund model?
I like both, but we've migrated to a fund model. Our biggest problem was on our syndication model. All of our deals were, way over subscribing. We would fill them up in hours, and then people were like, hey, I want to get in, and it's like, oh, too late, it's already closed. And like, but I just got a chance to read my email. It just came yesterday. And so, we moved to a fund model, which allowed us to just raise as much money as we could raise, and then buy as much real estate as we could buy with the money that we could raise. And that's worked out really well for us. It put us in a better position as a buyer, because sellers had more certainty we could execute because we already had the equity committed. So that was certainly our model. And it doesn't mean it's the right one. It's just what happened to work for us. I don't think that the fund model works well for newer sponsors. I know a lot of new people are like, oh, I've never done this before, I'm going to go raise a big fund and just go out and buy real estate. That's probably going to be challenging. I mean, it would have been challenging a year ago, and it'd probably be impossible today. So I think people just have to set their expectations correctly and realize that, fund is a little bit of more of an advanced strategy, and you got to have a good track record under your belt to move to a fund model. So
in your opinion, what is the major upside for the passive investor to look on the fund model, especially how they can actually mitigate the risk on the fund model?
Diversification, it really is the biggest advantage to the investor. They can make one investment, and with that one investment own multiple assets. I've always been a strong advocate of trying to minimize single points of failure. And that means, for the passive investor, that could mean investing in a variety of real estate product types. Like maybe you might invest some self-storage, some mobile home parks, some multifamily, some industrial, commercial, diversify across your portfolio with different product types. Also diversify geographically, don't concentrate all of your holdings, even passive ones, all in one area. Spread that out a little bit. And also don't invest all your money with one sponsor. Find multiple sponsors and invest your money across different sponsors. And by doing that, you eliminate or minimize single points of failure. And that's kind of what guarantees your long-term success in this business, because there's always a story out there somewhere of some sort of failure. It's either I invested in this deal and then the market in that area collapsed and I lost my money. Or it's, multifamily wasn't doing so well when I got in and so I lost my money. Or I invested all my life savings with one sponsor and he turned out to be a crook, stole all my money and fled to the Bahamas, and now I can't get any of it back. So, by diversifying across all those different ways, you can minimize your exposure to single points of failure as a passive investor.
Let's jump to your book. Can we speak a little bit about your book? It's one of the famous books on the market. I think it was with Bigger Pockets. It was a joint venture. I think so.
Yeah, they were the publisher. The book, The Hands-Off Investor, it's an insider's guide to investing in passive real estate syndications, published by Bigger Pockets Publishing.
Yeah, it was two parts. It's about multifamily, correct?
Well, it's kind of about multifamily, but really what it's about how to successfully invest as a passive investor. In other words, like how to, do your homework on syndication sponsors, how to how to not get taken for a ride, how not to lose all your money, all those things that you want to know before you start writing checks to a syndication sponsor or fund sponsor. You'll want to check out this book. I mean, it also talks a lot about commercial property underwriting, multifamily underwriting. So there's certainly a lot of focus in the book on the numbers behind these projects and how to make a decision as to whether or not the numbers are being presented to you are reasonable.
My next question will be the funny question, or the fun question here is how you describe your superpower.
I think that's a really, really good question. I think my superpower has been in avoiding as much market pain as possible, and kind of market timing has actually been pretty good to me. It's interesting how, I kind of stopped buying real estate a couple of years before the 2008 real estate collapse. And then I started again in 2009 when everybody said I was absolutely crazy.
Yeah.
But I mean, we really went into it hard in 2009 and managed to do very, very well as a result. And then, I bought a portfolio of, 120 single family homes, one at a time. It wasn't really a portfolio, but bought those 2009, 10, 11, and then sold them for 2.5 times the price. And, 14, 15, 16 after the single family market kind of ramped up. So that was good timing. And then we bought about 4,000 multifamily units. I sold, I think, about 2,000 or so units over the last, year and a half at what I would call the peak of the multifamily real estate market.
Yeah,
pretty good timing. And then I saw this collapse happening. I don't want to call it a collapse, but this little market reset happening earlier this year, and managed to get a couple properties into contract to new buyers right before everything started to tumble. So I think I've done pretty well at avoiding kind of the worst of the market collapses and taking advantage of some of the best of the market upswings. So that's been pretty cool.
I think basically good reader for the market performance and fundamentals.
Yeah, and a lot of gut feel.
Oh, okay. My last question will be how the people can follow your success and your company and the podcast too.
Yeah, so best ways to follow what I'm doing here is you can check out our company's website. It's Praxis Capital. The website is praxcap.com. It's praxcap.com. You can also follow me on Instagram at Investor Brian Burke. You can check out the book, The Hands-Off Investor, at biggerpockets.com/syndication book, or you can get it on Amazon or bookstores and that sort of thing. So yeah, you can also find me on Bigger Pockets on the forums, just answering questions, or check out the blog article for the Bigger Pockets
As
blog.
usual, you're really great help for all of the newbies on this market. So again, thanks a lot for being with us today. And we're really happy to bring you again to the show whenever you have time to give us more update about the market, about your knowledge and your success.
Thanks for having me here, Adam. It's been fun.
Thank you a lot, Brian.